Hey, Rebel Bankers, I'm your host, Chris Noggle, and welcome back to the show. I've got an exciting episode for you today. We're going to talk about the 10 most common mistakes investors make. And we're going to show you why you make these mistakes, not just what they are, so that you can get that mindset right and start course correcting so you don't end up losing money in your investments. But before we do that, let's talk about your journey to becoming a Rebel Banker. So on your journey, you're going to gather a whole bunch of knowledge. And you know, someone once said, knowledge is power, but I call their bluff. Knowledge is not power. You know what's real power? The application of knowledge. So whatever you learn here, apply this information. Whatever you gather, go out there and find something to apply it to in your life. And I'm just going to test your application skills right now. I'm going to give you something for free, but you got to do something to get it. I'm going to give you my book, Mapping Out the Millionaire Mystery. You can get this book for free, and all you need to do, here's you taking action. Go to chrisnoggle.com, and once you get there, one swipe, like the index finger, right? That one swipe up on your mouse, and right there you will see free book. So grab a copy of Mapping Out the Millionaire Mystery. I'm giving it to you for free. All you have to do is pay the shipping, and that's all you're doing is taking action. It's a great exercise. So go do that right now and take action. I'll wait. I'm just kidding. So let's dive into this. So what are the 10 most common investing mistakes the average investor makes? It's very simple. Let's start with the first one. I've got a nice little list here of 10 of them. The first one, you don't have a plan. Most investors invest without an investment plan. They literally have no direction of why they're investing, and they have no plan of how to invest. And you know, that set of rules ends up making it so most people do the complete opposite of what they're supposed to do. What is the number one rule in investing? What is the number one thing you should do? It's easy. Buy low. Okay. Number two, sell high. And number three, don't lose money. If number 1, 2, and 3, buy low, sell high, don't lose money are the rules, then why is it that every single investor that I usually come across, unless they're a professional investor, does the complete opposite? They buy high because it feels good. They sell low because they get scared and fear, oh God. And what do? They lose money. So folks, investment mistake number 1, investing with no plan. Let's move on to number 2. I love this one. It's called FOMO, F-O-M-O, fear of missing out. How many of you have ever had this happen? You're looking at investments and you're watching the market go straight up. It's just going up and up and up and up. And I've got the market right behind me. Just look at it. Like, what does it feel like when the market's going up? You're like, oh my God, I got to get into this. I got to take advantage of this. When you're at the casino and you're looking at the tables and people are winning, you're like, oh, I got to get into this. I'm missing out. When you do that, when you buy into FOMO, you are literally buying into a much higher probability of you losing money, because that whole euphoria, that whole FOMO, that missing out fear is exactly what you're going to do. You're going to miss out on the gains you could have made, and you're going to miss into the losses you're going to have, because usually when the market's where it's at right now, and it's going up and up and up, people start thinking, oh my gosh, I'm on the sidelines. I got to get in. Holy crap, I got to get more money in. I'm missing out. I don't want to miss these gains. Oh my gosh, Tesla just went up. Oh my gosh, Apple just went up. All these stocks are going up. I'm missing out. Folks, it is one of the biggest mistakes you can make in investing. And that goes to mistake number 2, FOMO. Don't ever think you are running the fear of missing out, because you're never going to miss out. There's always the right time to buy and the right time to sell. And you just got to follow the rules. What are the rules, guys? Buy low, sell high, don't lose money. Straight out of Warren Buffett's mouth. So let's go on to number 3. And I love this one. This is a very common mistake, and one that I'm seeing all the time right now. What is the mistake? Position size. So when you're investing, I don't care if it's in your 401k, I don't care if it's in your brokerage account, maybe you've got, just some other investment account that you're doing. One of the things people always do is they find 1, 2, maybe a couple different stocks and they go deep into them. A couple mutual funds, because that mutual fund's done so well in the past, I should keep buying it. And their position size keeps going up. But what professional investors do and professional traders do is they pay attention to their position size. And that position size, very simply, and I'm not including cash or treasuries or AAA rated bonds in this. So I just want you to exclude those three for now. I'm talking pure stocks or equity-based mutual funds or ETFs. When your position, your one stock, your one mutual fund, your one ETF, unless it's an index, gets over 5%, you are overweighted. So let's just pick on stocks, okay? I know a lot of people, they get really hung up on one stock. Like Tesla was the rage last year, or Apple was the rage, or any of the FANG stocks. They were the rage. So people balked up on them. And, maybe they went into it with the intention of having no more than 5% of their total portfolio. So if you take your total portfolio, okay, 5% of that total portfolio is all that should ever be in any one stock. It's really just diversification and protection. Because what happens when you get too much money in one basket, right? All your eggs in one basket, you run the risk of losing. So let's talk about that. Let's just say you did buy one of these highly appreciated stocks that I mentioned, one of the FANG stocks. You had bought that, back last year. And that thing's gone up and up and up and up and up. And now all of a sudden, if you look at your overall portfolio, your total portfolio, that one stock makes up 20 or 30% of your entire portfolio. And you might sit there and say, yeah, but it's doing well, it's okay. When it isn't doing well, you're not going to like the outcome of being overweighted. So just always keep it in your mind that no one stock should make up more than 5% of your total portfolio. The rules change a little bit when you go to mutual funds or ETFs. But again, just always remember 5% rule. Just try to keep your position size to any one stock or any one position at 5% or under of your total portfolio. It will save you, because then if that one stock takes a big dump and loses 30, 40, 50%, you're like, well, I only had 5% in it. But what would you think if that 30% stock that you have a stock that has 30%, if that dropped by 30, 40, or 50%? You'd be like, holy crap, I can't retire. Holy crap, my kids can't go to school anymore. Holy crap, I just beeped up. You get the drift. All right, let's move on to the next one. This is my favorite, and I'm ramping up for this. Number 4, most common investment mistake. And it goes along with a song we all know so well, and it's Freakout. You guys remember that song? Freak out. I'll play that song for you, but don't freak out. So what happens is investors, their emotion gets involved, and they're so used to the market going up, the fear of missing out, that it's going up and it's going up and it's going up. Then all of a sudden something happens, and then all of a sudden it's going down. And oh my God, one day it lost 5%. The next day it loses 10%. Then oh my God, now it's down another 10%. You freak out and you do what? You violate the rules. You sell low. You bought it high and now it's going down and you sell low. So avoid the freak out. And every time you think about that and you're sitting there watching one of your stocks go down, you think to yourself of that song, Freak Out. Yeah, I can't sing. But anyway, you remember that song. All right, so let's move on. Number 5. And this one goes to some of the other mistakes that I just mentioned, but rebalance often. Pick a rebalancing strategy and look at your entire stock holdings or your mutual fund holdings and go through it and set yourself some rules. Remember, mistake number 1, people trade without a plan, without rules. This is one of your rules. Rebalance often. How often? Well, quarterly would be good. Some of you, if you're active, could be monthly, but if you rebalance your portfolio quarterly and you say, okay, I don't want any more than 10% in equities. I want 30% in cash. I want 15% in gold or alternatives. I want, 35% in treasury bonds and AAA rated corporate bonds. But then all of a sudden, one or the other goes up or down, and now all of a sudden you're out of whack. Maybe now your cash is 35% and your equities are now, 20% and your treasuries are down. Rebalance it and go back and just, your portfolio, you have your position size, let's say 30% cash, 10% equities, 15% alternatives, 10% gold and precious metals, and 35%, 20, 30-year treasury bonds or 20-year AAA rated bonds. If I did my math right, that's 100%. Now, if it gets out of whack from that original plan, that portfolio, makeup, what you want to do is rebalance it. So every single quarter, put it in your calendar. It'll take you all of 5 minutes, and go into your portfolio, your 401k, your IRA, maybe your brokerage account, and just rebalance it. Just do the math. My portfolio size is X, okay? And then these are my positions, and if it's above or over, fix it. Rebalancing works, folks. It's why the professional institutions do it. It's why professional traders rebalance often. Some of them rebalance weekly. You should be doing it too. It is a big mistake that investors make because they just don't pay attention. And if you don't pay attention, all these mistakes are going to hit you all at the same time. And folks, we've only been to 5. We got 10 of these. So let's keep going. Let's go to number 6. And this one might be my all-time favorite. This is the fear of taxes. Investors fear paying taxes. Taxes, folks, are the luxury of making money. I don't like paying taxes no more than any of you. And I'm not saying taxes are good. I'm not saying be happy you got to pay taxes. But you know what? There's 2 certains in life, death and taxes. And, you could throw something else in there, but we're going to leave that alone. 2 certains. So just get used to it. So if you've got a highly appreciated stock or a highly appreciated investment, you're looking at it and you're like, that Chris guy on that podcast said one of the rules is sell high. I did right. I bought it low and now I've got to sell it high. But oh my gosh, I'm going to have to pay tax on all those gains. And you don't sell because you're like, I don't want to pay tax. Or you come up with some crazy idea in that mind of yours because you got a mindset problem. You come up with some crazy idea that justifies why you shouldn't sell it. Fear of missing out. You don't want to pay taxes. So you got the fear of taxes. Something happens and you're like, I'm just going to hold it. So here's the good news, folks. I have a great strategy for you to avoid the fear of paying taxes. You want to hear it? You guys ready? Come on. Give me a drum roll here because I got a good one coming. Drum roll. Here is how you avoid paying taxes. What you do is you don't sell it. You just wait, okay? And then eventually in time, what happens is that stock or that investment will go down. And you just watch it as it's going down. You got a little freak out, but you said, I got to avoid that freak out. And it keeps going down. It keeps going down. It keeps going down. And all you need to do is make sure that investment goes below what you paid for it. And then you sell it. And then what do? Well, now you get to write off the tax loss, right? You got a loss. You lost money. So now you can write that off against your taxes. What an awesome strategy, isn't it? Because if you're afraid of paying tax on the money, well, just wait till your investment loses money and then sell it. It's a great strategy. I hope you all know I'm freaking kidding. Get your mindset right. Look at, if you pay taxes, pat yourself on the back. Okay. Go get your dog to shake your hand or your cat to pat yourself on the back. Whatever it takes, be thankful that you made money and sell high. It's one of the rules, folks. Let's go over the rules again. Buy low, sell high. And if you do those, rule number 3, you can't lose money. It's quite simple, folks, but we just ignore them. And folks, that was mistake number 6. Let's go on to mistake number 7. Yeah, this is a good one. This is one that even myself have had a very hard time with. So folks, if this is a mistake you make, this is a mistake I make. And you know what it is? Mistake number 7, trying to time the market. Right? Behind me, I've got a stock chart. We look at this thing and we're like, oh my gosh, I'm going to get out right before the market goes down, or I'm going to buy in when the market gets to the lowest point, right? We're always trying to time that perfect time to buy, and we rationalize that. Here, let me tell you why this is a mistake. It don't work. Quite simple. There you go. It don't work. Ray Dalio, some of the greatest minds in investing will say the exact same thing. You cannot time the market. And if you try to, you will miss the market every time. So don't do it. Don't time the market. Trade with a plan. Set your rules, okay? And go for it. Stop trying to think you are better than Ray Dalio, Warren Buffett, and all the great investment minds because you, for some reason, have cracked the code and you know how to time the market. No, you don't. You're joking. You're messing with your mind. You can't time the market. And that's why it's mistake number 7. You guys getting this stuff? You guys writing this down? Because if you're not, go back and write this down. I hope you guys are paying attention because a lot of people listen to this, but they do nothing about it. What did I say the biggest problem is? It's not knowledge. It's not applying knowledge. You guys need to apply these these mistakes and these rules so that you can go out there and crush it, make a ton of money, make sure that you live a better life, have a better, foundation of wealth for your family. Come on now. All right, mistake number 8. We're getting to the finish line here. Mistake number 8, failure to diversify. Okay, so many people, they just pick the 1 or 2 winners when it's going up, because they got that fear of missing out. So they're buying into just the winners and they don't diversify. How many of you really, think about this. How many of you right now have cash in your investment portfolio? How many of you actually have a cash position? Mine, 30% always. And some people would be like, that's ridiculous. You're not making any money on cash. And I say, yes, but you know what? When it all goes down, I don't lose in cash. And what I then can do is take my cash and buy low, because that's one of the rules. Buy low, sell high, and don't lose money. I keep saying it because I'm trying to burn it into that mind of yours, because I know as many times as I try to teach you this, you're just going to be like, well, I'll get to that. Or you're going to say down the line, I should have, I could have, I would have. Folks, just follow the rules and realize that these are the mistakes. So if you're making these mistakes, fix it, okay? You're not driving your car around on a bald or flat tire because you knew better to fix it. Well, this is a problem you need to fix too. So do not fail to diversify. Make sure you have an adequate diversification strategy on your investment portfolio. And it's different for everybody, okay? 30% might not be your number for cash. Whatever your portfolio looks like, just make sure that it's diversified across a lot of different things. And not only diversifying your investment holdings, diversify your income streams. How many of your stocks pay dividends? Are you reinvesting the dividends? Are you taking the dividends out and putting them into privatized banking or those specially designed and engineered whole lives where they're guaranteed? Folks, also diversify your income streams. Some of the great minds out there, the Kiyosakis of the world, the Tony Robbins of the world, they talk a lot about, it's not about how much money you have on paper, your paper assets, it's about how many of those paper assets provide you an income stream, passive income. So look at your diversification, not only of your portfolio, but also diversifying your income streams. So that is investment mistake number 8. Here we go. Investment mistake number 9. And I love this one. Get even. How many times do you remember back when you were a kid, someone did something to you and you're like, I'm going to get even on him or her, right? And even in business, you're like, I'm going to get even. That person did me wrong. I'm going to get even. Well, you think the same way with your investment portfolio. When you lose, you're like, oh, I'm going to get even. I'm going to wait that out. I'm going to do this. I'm going to do that. You're going to get even. No, you're not. No, you're not. In most cases, you're not going to get even. And how many times in your life have you said, I'm going to get even with that person? And you never did. You just forgot about it. And then, you went out, you had some cocktails with the person, you're good. And you're just like, I said I was going to get even, but I didn't. You're not going to get even in your investment portfolio either. So stop thinking that you are. Let me just tell you how you'll never have to worry about getting even in your investment portfolio. Put insurance on your stocks. And you're probably like, what do you mean, Chris, insurance? It's called a stop loss or a stop limit order. Okay, everything you buy, you should have a limit that you're willing to go down. If you buy something at 100, you might say, okay, I'm willing to lose 3%. And after 3%, I want it gone. I don't want to lose any more than 3%. Do you guys all know that you actually are in control of doing that? Not in your 401k, not in some IRAs, but if you have a stock portfolio and you bought a stock or an ETF, you definitely can put a stop loss or a stop limit order on that particular one so that it sells exactly where you want it to sell. So you are in 100% control of how much money you can lose. Wouldn't that be nice? You invest in stocks and whatever you invest in, and you look at it and you say to yourself, I can only lose 5%. Well, people would say you're crazy. What do you mean you can only lose 5%? Chris, you're not in control of that. Like the market determines your loss. If you go down with the market, you're going to lose more than 5%. I put insurance on my portfolio. And they're just like, oh, great. Is this something I don't know about? Who's lying to you now? That sounds too good to be true. No. All I do is I use stop losses. I went through all the positions that I bought. And if that position goes down by more than 5%, it sells me out automatically. I could be taking a nap in the afternoon. I could be out with you having a cocktail. I could be at work actually doing what I'm supposed to be doing. And if that stock goes down 5% or more, it stops me out, sells it, and I'm good. And I look at it later in the day. Sure, I'm not happy about that loss of 5%, but you know what? I was out having a good time or doing my job, and my portfolio was taking care of itself and making sure that I didn't lose more than I wanted. Now, how important would that be in the event of, say, a flash crash? Or one of those days, where you see it on the market's down 1,000 points. It's triggering all the stop limits and all the stop losses. The circuit breakers are all tripping. You know what all those are? Circuit breakers, stops, all those things. What I just told you about. It's your insurance, folks. Make sure you're using stop loss or stop limited at the bare minimum. But if you don't know what I'm talking about, there's this thing called Google stop loss, and just see what comes up. Look at the Investopedia, go on and watch some YouTube videos on how to do this. Folks, it's available to each and every single one of you, unless you're in one of those things we like to call a 401k or an employer-sponsored retirement plan. And that's a whole nother ball of wax. So we're not going to go into that one. And now we are at number 10, the number 10 most common mistake investors make. Here it is, giving up control of their money. You heard me. How many of you are doing that? Come on, let me hear it. How many of you are actually giving up control of your money? Do you even know what I'm talking about? How many of you manage your own portfolio? Or how many of you have been convinced at one point or another in your life that you're not good enough to manage your own money? You can't be a good steward of your own money? Oh my goodness, no. That's way too complicated. That's way too hard. That's way over my head. That's way over my pay grade. Stop lying to yourself. You've been lied to your whole life when people told you you're not a good steward of your money or you're not smart enough to manage your own money. Folks, you're smart enough to manage your own money, but you might have to learn a little bit. I'm giving you 10 mistakes in one simple rule. You probably, if you followed what I'm teaching you here, you probably would do better managing your own money, your own stocks, your own investment portfolio than paying somebody else to manage it. Now, listen, I'm not taking any credibility away from advisors or money managers. They're there to do a good cause. But I want you to understand that the second you give up control to somebody else, you are literally agreeing that you are not capable of doing it yourself. And I got to ask, why? Oh, I didn't go to school for that. No, neither did most of them that you're giving the money to manage. They probably didn't go to school. Oh, but they have licenses. So can you. Okay. Listen, stop making excuses and start learning how to do it yourself, because you're your best chance. Folks, the cavalry's not coming. I'm sorry to tell you, but the cavalry's not coming. This is on you. So start taking back control of your money and stop avoiding the number 10 most common mistake, and that is you gave up control of your money. So folks, we hit 10 of the most common investment mistakes there are out there. And I hope you guys wrote these down. If you didn't, I hope you go back and you rewrite these all down. This is important stuff. And then I gave you one set of rules, okay? 3 rules: buy low, sell high, and don't lose money. And if you just do 1 and 2 and you skip number 3 is an automatic bonus. So there you go. That's my bonus to you. Folks, thank you so much for joining me. I hope you got some golden nuggets out of this. I hope you actually apply some of this knowledge, because otherwise I'm just wasting my time and you're just wasting yours. So apply this knowledge. And also, remember earlier what I said? I want you to practice application of knowledge. My book, grab a copy of Mapping Out the Millionaire Mystery, and how you do that. Again, if you're jumping on or you're just not paying attention, go to chrisnaugle.com. One swipe on that little thing they call a mouse, one swipe up, you'll see it, free book. So folks, start applying knowledge. Start taking back control of your money and stop making stupid mistakes with your investments that are going to cost your financial future. Folks, thank you. And I'll talk to you soon on the Real Estate Money School. Until then, see you later.